All right, guys, today I'm going to teach you everything you need to know about how taxes for stocks work in 2025. Whether you're brand new to stock investing or if you have a portfolio and you've been doing this for many years, you'll need to know all of this information that has been updated as it pertains to your portfolio. So make sure you stick all the way till the end of this video. Without further ado, let's dive in. Realized versus unrealized gains. Many investors hold stocks in their brokerage accounts without selling them throughout the year. They simply buy and then let them sit. If you do this and your stocks perform well, your account value will likely grow. However, here are the key points you need to know. You won't owe any taxes if you don't sell your stocks. And this is because you haven't technically made any money yet. You've only achieved what's called an unrealized gain. Now, an unrealized gain refers to the potential profits that exist only on paper until the stocks are sold. It isn't considered real until your cash out happens. Now, let's talk about realized gains. These occurs when you actually sell your stocks and make money as a result. This is when you take profits off the table. It becomes a taxable event. Understanding stocks gains is very important. Let's go over an example. Imagine you purchase $10,000 worth of Google stock, and let's say the price of the stock doubles to $200 per share, but you don't sell. Your total position is now worth $20,000, giving you an unrealized gain of exactly 10 grand. Since you haven't sold yet, you don't owe any taxes on this gain. However, if you did decide to sell all 100 shares, you'd get back your initial $10,000 investment plus an additional $10,000 gain, which is now considered a realized gain. This $10,000 gain is taxable. Now, let's talk about capital gains tax rates. The amount of time you hold onto a stock before selling dramatically affects the taxes that you're going to pay. This is because there are two types of gains that you get to pay taxes on: long-term capital gains and short-term capital gains. Long-term capital gains are profits from stocks held for at least 1 year. The maximum tax rate that you can pay on these types of gains is 20%, though it could be as low as 0%, which most people forget about. Depending on your income level, it could be 0%. So you won't pay more than 20% on long-term capital gains. Short-term capital gains applies to stocks held for less than a year. This means you're trading quickly. You're taxed at ordinary tax rates, which range from 10% up to 37%, depending on your income. So if you're in a high income bracket, you could pay significantly more taxes on short-term gains than on long-term capital gains. But here's what I want you to remember. Short-term gains are taxed the same as your ordinary income. Now, what happens if you keep the profits inside of your brokerage account? You pulled it, but you kept it there. Some people mistakenly think that they don't owe taxes on their stock gains as long as they leave the money in their brokerage account and then don't transfer it to themselves. Unfortunately, that's not true. When you sell stocks at a profit, it triggers what's called a taxable event, meaning you, the individual underneath the brokerage account, owes taxes on that money. Whether you move the money back to your bank or leave it in the brokerage account, you still owe taxes on those profits. Even if you hide your profits, the IRS will come for its share. How do they know? Well, your brokerage sends a Form 1099-B to both the IRS and to you. This form reports your capital gains and losses. So yes, the IRS will know exactly how much money you made or lost from your stock trades. This means you must report your capital gains, whether long-term or short-term, whether you move the money or don't move the money. Hiding profits from the IRS is not something you should ever do, and there can be serious consequences for trying to do so. It's much safer to simply report it and do tax planning with a real tax strategist. Now, what about stock losses? Not every single stock is going to perform well. Not every single investment results in a profit. Many investors end up losing money. But here's some good news. Stock losses are deductible. If you lose money, you can use those losses to offset any gain you've made. But sometimes you may have more losses than gains, and in this case, you can only deduct $3,000 of your losses from your other forms of income, such as your W-2 or 1099. For married couples filing separate, it gets cut in half to $1,500 per person. While it's nice that the IRS allows this deduction, remember, there's still limits. It's still important to invest wisely and build a solid strategy around that rather than relying on tax write-offs for bad investments. But here's some good news. If you don't use all of your losses in 1 year, you don't lose them forever. You can just carry them forward to offset future capital gains. For instance, if you had a $6,000 loss in 2023 but no gains, you can deduct $3,000 in 2025 and carry over the other $3,000 to 2026. You can report all of this, by the way, on your Schedule D on your tax returns. Brokerages provide the necessary details on Form 1099-B, which you'll use to fill out your return. Now, some people make the mistake of overlooking their tax losses. By doing this, you could cause yourself to miss out on tax savings. Please make sure that you always have a conversation with your financial advisor at year end. How are dividends taxed? Some stocks pay dividends, which are regular payments to shareholders from a company's profits. If you own dividend-paying stocks, congrats, you'll be receiving these payouts, and they typically range from 1 to 5% of the share price. While dividends are related to stocks, they have their own set of tax rules. There are two types of dividends you could be receiving: ordinary and qualified dividends. Ordinary dividends are taxed at ordinary income rates, which can go all the way up to 37%, while qualified dividends are taxed at a maximum 20%. Let's look at an example to help you understand the key differences between the two. Let's say you own 200 shares of company X, and they pay you an annual dividend of $2 per share. That means you receive 200 shares times $2 per share for a total of $400 in total dividends. Now, how are those $400 in dividends taxed? If these dividends are ordinary dividends, they're taxed at your ordinary income tax rates. The ordinary income tax rate can range from 10% to 37%, just depending on your taxable income. Here's an example. If you're in the 22% tax bracket, your $400 in ordinary dividends would be taxed at 22%, which would result in about $88. So if these are ordinary dividends, you would owe $88 in taxes on your $400 in profit from dividends. What about if it was a qualified dividend? If these dividends are qualified dividends, they are taxed at a lower rate than ordinary dividends. Qualified dividends are typically taxed at long-term capital gains rates, which ranges from 0%, 15%, and then a maximum 20%. So here's an example. If you're in the 22% tax bracket, your $400 in qualified dividends would be taxed at 15% long-term capital gains rates. Your total tax due would be $400 times 15%, which would be about $60. So if these dividends are qualified, you would owe $60 in taxes on your $400 in dividends. Now, how do taxes on stocks work for stocks in 401ks or IRAs? See, many people own stocks in their retirement accounts, their 401ks, or their IRAs. And if you're in this category, you need to know that taxes on these stocks in your retirement accounts works a little bit differently than taxes held in a standard brokerage account. The way the taxes work for stocks on 401ks and IRAs depends on whether your 401k or IRA is a traditional account or a Roth account. Traditional 401ks and IRAs are completely different than normal brokerages. For 401ks and IRAs, the amount of money that you contribute to these accounts each year is subtracted from your pre-tax income. So you get an immediate tax benefit every year to contribute to these accounts. Then your account grows tax deferred, and you only pay taxes on the account's earnings when you withdraw them in retirement. So let's just say, for example, you contribute $30,000 to your traditional 401k for 10 years. Every year, $30K, $30K, $30K. Your taxable income for the year will be reduced by $30,000 every single year. Then you will only be taxed on the account's profits when you retire. So if the stocks in the account generated $150,000 in capital gains during the 10 years that you held it, you would owe taxes on the $150,000 when you withdraw it. What about Roth 401ks and IRAs? Roth 401ks and IRAs also have tax advantages. However, the way that taxes work for these accounts is a little bit different than the way that they work for their traditional counterparts. For Roth 401ks and IRAs, contributions are made with after-tax dollars. So as a result, you're going to pay taxes first. The IRS gets to collect money on that, and your account gets to grow tax-free. This means that the profits that you make on the investments in your account will be completely tax-free, which means you could also completely withdraw them tax-free, not a dime to Uncle Sam. So if you contribute $30,000 to a Roth 401k every year for 10 years, and if your account generated $150,000 in profits during the time, you would not owe any taxes on the profits when you withdraw them in retirement. Many people prefer Roth 401ks and Roth IRAs because of this fact, and they won't get hit with a large tax bill in their retirement. But if you do not qualify because of your income, because you're making too much money, this is when I'd highly recommend that you look at doing a backdoor Roth IRA or a mega backdoor Roth IRA. If you have questions about this, check out this video right here. Now, here's a question that came in from one of my subscribers. This question was asked by JCore3868 on the United States tax code has a marriage penalty video. If you haven't seen that one yet, that's a great video for you to go check out, especially if you're married. The question was, Karlton, if I'm married, could I file separately, and how could I do that? The answer is true. When you're filing separately, you're choosing to keep all your finances completely separate. You're going to file your own 1040 tax return, which means you're going to report your own expenses, your own deductions, your own 401k contributions. This will also limit the amount of deductions and tax credits you get to take because the IRS penalizes married couples for filing separate. But if you choose to file separately, your spouse will file her own separate tax return and you will file your own tax return when you go to meet with your CPA or you use your own accounting software such as TurboTax. My name is Karlton Dennis. Thank you so much for joining me for this video. I hope you learned a little bit more about taxes today. If nothing else, I'd love for you to like, subscribe to this channel. We look forward to teaching you more tax education that will help you get closer to financial freedom. Thank you.